Welcome to Crypto Law Decoded. I'm Rama, and today we're shining a light on the top 5 crypto scams and legal pitfalls and how you can avoid them. Before we get started, a quick legal disclaimer. This video is for informational purposes only and not legal advice. Cryptocurrency is an exciting space, but it's also full of scams and traps. How bad is it? The U.S. Federal Trade Commission reported that since 2021, more than 46,000 people have reported losing over $1 billion to crypto scams. That's billion with the B. So let's count down 5 of the biggest crypto scam types and pitfalls and give you tips to steer clear of them. 1. Ponzi schemes and high-yield investment scams. These are schemes where earlier investors are paid with money from later investors, all to fake the appearance of a profitable venture. Scammers promise absurdly high guaranteed returns, like 1% profit every day. One infamous example was BitConnect, which turned out to be a textbook Ponzi scheme. They claimed a trading bot guaranteed huge returns, but in reality, they were just recycling new investors' money to pay earlier investors. How to avoid? Be extremely wary of any investment that guarantees high returns with little risk. In crypto, consistent daily gains with no risk simply don't exist. If you can't tell how a project is actually generating money beyond bringing in new investors, stay away. Remember, if it sounds too good to be true, it probably is. 2. Rug pulls and fake tokens. A rug pull is when developers hype up a new cryptocurrency or DeFi project, attract lots of investors, then suddenly withdraw all the funds and disappear, pulling the rug out from under investors. These scams often involve new tokens that skyrocket in price and then plummet to zero because the creators drain the liquidity. For example, the infamous Squid Game token scam lured people in with hype and then the creators vanished with the money. How to avoid? Be very cautious with brand new projects, especially if the developers are anonymous or unverified. Check if the project's code or contracts have been audited by reputable third parties. If a token's price spikes overnight purely due to social media buzz, be suspicious. It could be the lead up to a rug pull. Also, examine the token distribution. If a small team holds most of the supply, or there are restrictions on selling, that's a glaring red flag. 3. Phishing scams and fake apps/exchanges. Not all crypto scams are about fake coins. Many are about stealing your credentials. Phishing scams involve fake websites or apps that look like legitimate exchanges or wallets. You might get an email that appears to be from your exchange asking you to log in via a provided link, but it's a trap to capture your password. Or you search for a wallet app and accidentally download a fake one that steals your private keys. A particularly insidious scam is when someone impersonates tech support or even a friend online to trick you into giving up sensitive information. There's also the pig butchering tactic, where a scammer builds an online relationship with you through dating apps or social media, earns your trust, then convinces you to invest in a phony crypto platform. Once you send the money, it's gone. How to avoid? Never click login links from emails. Instead, go directly to the official website. Double check the URL of any site you use. Scam sites often use addresses that look very similar to the real ones. Use two-factor authentication on your accounts to add a layer of security, and never share your wallet's recovery phrase or private keys with anyone. No legitimate company will ever ask for them. If someone online, even if they seem friendly or helpful, is urging you to send crypto or reveal personal information, extremely skeptical. 4. Pump and dump schemes, influencer hype. This is where a group of people artificially inflates the price of a coin through hype and then sells at the peak, crashing the price and leaving others with losses. It often starts with promoters, sometimes even well-known influencers, picking a low-valued coin, spreading optimistic rumors or endorsements to drive the price up, and then dumping their holdings once enough unsuspecting buyers jump in. Suddenly, the coin's value collapses, and latecomers are left holding the bag. Some social media figures have been caught doing this, pushing a coin to their followers, then quietly selling their stake as the price rises. How to avoid? Be wary of sudden hype around a coin, especially if the source is just buzz on Twitter, Reddit, or YouTube, rather than real news or technical developments. Don't let FOMO, fear of missing out, drive your decisions. If an influencer is shilling a coin or promising it will go to the moon without solid evidence, think twice. Do your own research into what the project actually is. 5. Legal pitfalls, tax traps, and compliance risks. Not every pitfall is about someone scamming you. Sometimes the danger is not following the law. A big one is tax trouble. Many people don't realize that selling, trading, or earning crypto through interest, staking, etc. often triggers taxable income. If you ignore those taxes, you could face penalties or audits. Another legal pitfall is getting involved with projects that aren't following regulations. For example, if you buy into a token sale that is actually an unregistered securities offering, regulators could crack down on it. The project might get shut down and you could lose access to your funds. Or if you're using a crypto platform that operates outside the law, no licenses, no KYC, etc., it could suddenly be closed by authorities, again putting your assets at risk. How to avoid? Stay informed about your responsibilities. Keep records of your crypto trades and consult a tax professional if needed to make sure you're reporting things correctly. It's better to pay taxes than to get hit with an enforcement letter later. Be cautious of projects that boast about no KYC, no regulation as a feature. If they're openly flouting the law, that's a huge risk. When investing in new tokens or platforms, consider whether the team appears to be compliant. For instance, do they have clear terms of service, a known team or company, and a legal game plan? Sticking with reputable, legally compliant exchanges and services, even if they ask for verification, can save you a lot of trouble down the road. To wrap up, the crypto world has incredible opportunities, but also plenty of pitfalls. The good news is that by staying informed and a bit skeptical, you can avoid almost all these scams and headaches. Always do your own research. Never rush into deals because of hype. And when in doubt, get advice from trusted sources or professionals. If you found this video helpful, smash the like button and subscribe to Crypto Law Decoded for more tips on staying safe and legal in the crypto space. Have you encountered any scams or tricky situations? Feel free to share them in the comments. Your story could help someone else. And let me know what topics you want to see in future episodes. Thanks for watching, and as always, until next time, stay informed, stay legal.